So, what do you need to know about IRS Notice 2022-53? Well, here to talk with me about this is Denise Appleby from Appleby Retirement Consulting. Denise, welcome.
Thanks for having me. I almost said welcome, but thanks for having me. How are you?
Great. So the topic is an IRS notice that has some implications for folks. Care to walk us through it?
Absolutely. So I gotta start from the beginning, as they say. You remember the Secure Act, right? Secure
Yep.
Act was signed into law in December of 2019, became effective 2020. Now, part of the language in Secure Act said very clearly in black and white, if you are a designated beneficiary, meaning that you don't meet certain carve out exception, you're no longer eligible for the life expectancy option. Instead, you're subject to the new 10-year rule. And under that 10-year rule, distributions are optional from years 1 through 9, but you got to empty the account by the end of year 10. And part of what they use to explain that, so we could see it visually, is remember the old 5-year rule? That's exactly how it works, except now it's 10 years. And so that seems very clear to me and pretty much everybody else in the industry. So we've been telling people if you are a designated beneficiary, this is your option. 10-year rule, doesn't matter at what age the account owner died, because that's what the Secure Act said. You're subject to that 10-year rule. Fine. So we had beneficiaries who inherited retirement accounts in 2020 and 2021, and they didn't take distributions and didn't plan to because they think they didn't have to.
Mm-hmm.
So, as the IRS and Treasury is required to do, Bob, they issued proposed regulations where they explain what the Secure Act means. And part of what they said is if you are a designated beneficiary, it is true that you're subject to the 10-year rule. And it's true that if the IRA owner, when I say IRA owner, I'm talking about 401ks, all of them, but let's keep it simple. It's true that if the retirement account owner died before their required beginning date, which is April 1 of the year that follows the year in which they reach age 72, then you're subject to that plain 10-year rule where distributions are optional years 1 through 9, but you got to empty the account by the end of year 10. We're on track, right? However, there has to be a little twist. They said, listen, there was an old rule under the current proposed regulations that are final that says, and the tax code too, that says if the IRA owner died on or after the required beginning date, then they have to continue taking RMDs at a rate that is at least as rapidly at the rate that the retirement account owner was taking RMDs. And that applies to everybody, including those who are subject to the 10-year rule. And what this translates to is that if you're subject to the 10-year rule, Bob, and you inherited the account from someone who died on or after the required beginning date, then you have to take annual RMDs. And you still got to empty the account no later than the end of the 10-year period. So the problem is that there were beneficiaries who were subject to the 10-year rule that didn't take RMDs for 2021 and didn't plan to for 2022 because people like me told them that they didn't have to.
Right.
Everybody else told them that they didn't have to. So when the IRS issues proposed regulations, they open it up for comments. And people were knocking on their door, Bob, saying, you fooled us. You told us that we didn't have to take RMDs. Now my advisor is telling me that I owe you a 50% excise tax because I didn't take an RMD that everybody told me that I didn't have to take. You got to fix this. And so notice 2022-53 was that fix. And the way they fixed it was to say, listen, you're still subject to the 10-year rule. You're still required to take distributions at least as rapidly rate, which means that if you inherited an account in 2020, you had to take RMDs for 2021, 2022, and after up to your life expectancy or the end of the 10-year period, whichever comes first.
Mm-hmm.
And if you inherited the account in 2021, same thing, started 2022. However, if you didn't take that RMD, then we're not going to assess the 50% excise tax that usually applies to someone who doesn't take any RMD that they should have taken. So the question, there are a couple of questions or a few questions that came up out of this. Who really is eligible for this waiver? Because now I see the crowds clamoring saying, oh, I don't have to take RMD. Well, pump the brakes, because that's not true for everybody. That's true only if you're subject to the 10-year rule. Now, stay with me on this. You're subject to the 10-year rule under one or two circumstances. If you inherit the account and you're a designated beneficiary, right, you're subject to the 10-year rule. But if the account owner died before the required beginning date, you don't have an annual RMD, so you're safe. But if the account owner died on or after the required beginning date, then you're affected, but you get a waiver.
Right.
There's a second class of beneficiary that's affected, and that's a beneficiary that inherited the IRA from an original beneficiary that was taking distributions over their life expectancy. Now, that can be one or two people. A designated beneficiary who inherited the IRA before 2020 and was taking distributions over their life expectancy, or an eligible designated beneficiary who inherited the account after 2019 and was taking distributions over their life expectancy. You would then be considered a successor beneficiary. You are subject to a 10-year rule, and you must continue taking distributions over the life expectancy that applied to the original beneficiary, but you have 10 years to empty the account. So that's two separate 10-year periods that we got to keep track of, and only those people are eligible for this waiver of the excise tax. Now, I want to make a very important distinction here. This is a waiver of the excise tax. It's not a waiver of the RMD. Do you remember in 2020 when we had COVID and the CARES Act and they waived RMDs? That was different. When they waived those RMDs, they said, we're killing RMDs for 2020. There is no RMD. Don't have to take it. Did you take it? You can roll it over. This is different. There's still an RMD, but if you didn't take it and you fall under one of those two categories, then they're not going to assess the 50% excise tax. So that's a very important distinction to make, Bob.
So if someone took the RMD, they're safe. If you didn't take the RMD, you potentially get the waiver.
You get the waiver if you fall under one of those two categories. Yes.
Yeah. So maybe some folks would be confused by whether they're a designated beneficiary or not. Do you find that to be true?
Yes. So let's assume that you inherited an IRA in 2020 or after. Part of the question has to be, are you an eligible designated beneficiary or just a plain designated beneficiary? Now, a plain designated beneficiary is a person, right? And some qualified see-through trust are also designated beneficiaries. But in order to be an eligible designated beneficiary, you first must be a designated beneficiary, and then you have to be under or meet certain requirements at the time of the IRA owner's death. And these are, you're the surviving spouse of the IRA owner, you're the minor child, meaning you haven't reached age 21 of the IRA owner, you're disabled, chronically ill, or not more than 10 years younger than the IRA owner. If you fall into one of those categories, you are an eligible designated beneficiary. You don't qualify for this waiver. You know why? Because it was clear from the get-go that you were supposed to be taking annual RMD. So there's really no excuse. Now, if you didn't take your RMD and there's a good, reasonable reason why you didn't, then you can have a conversation with your tax advisor or tax preparer who can then file IRS Form 5329 and ask the IRS for a waiver. But you wouldn't qualify for this automatic waiver.
Right. So then the next question is, going forward, if someone was to inherit an IRA from someone whose required beginning date had already begun in 2022 or 2023, they still have to take the RMD and then exhaust the account within 10 years?
If they are a designated beneficiary, yes, that's true. So if you're a designated beneficiary and you inherit the IRA from someone who died on or after their required beginning date, yes, you got to take distributions over your life expectancy, and you have 10 years in which you have no more than 10 years in which to distribute the account. Notice I corrected myself and said no more than 10 years, because there's that narrow group of beneficiaries who have a life expectancy of less than 10 years. I think it's when you are maybe 80 or something, but we can check the single life expectancy table. But just be careful, if you're very old and you're a designated beneficiary, you could have less than 10 years. So right. 10 years is the max, but if your life expectancy ends earlier, then you have to end it earlier.
Right. So I guess the big question for folks then is to determine, one, if they're a designated or not beneficiary, and then because many people might be operating under the assumption that they have 10 years to drain the account.
That is true. You know, when clients call me, Bob, they'll say, Denise, my client's 58, inherited an IRA. What are their distribution options? And I'm like, are you serious? You know you can't just ask me that. You got to tell me, what's the date of birth of the account owner, what's the date of death of the account owner, and the objective is to determine if the IRA owner died before the required beginning date or not, because right. That's part of the equation that drives the distribution options. I also want to know, are you just a plain designated beneficiary or an eligible designated beneficiary? Because that too drives the distribution options. And finally, Bob, I want to know, are you the original beneficiary, or are you a successor beneficiary where the original beneficiary died and passed it on to someone else? So you got to know to ask the right questions and never make an assumption that the person who's sitting in front of you is saying, I just inherited an IRA. Don't assume that anything at all. Ask them all those questions. You know, you also want to find out if they were a sole primary beneficiary, because if they weren't the only beneficiary, then it's possible that the factor that is used to calculate the RMD might change if certain actions are not taken by December 31st of the year following the year of death, such as separate accounting of the assets.
All right, so let me give you an example before we close up. Let's assume someone is 60 years old. They have a inherited IRA that they inherited from their parents, let's say. A child who's older than 21 is the beneficiary, and that person who's 60 dies. The person who inherits the inherited IRA now has to do what?
Okay, so now we have two deaths occurring, right?
Right.
It depends on who was the original owner. Let's assume that the original owner was a parent.
Yep.
Who died at age 80.
Yep.
They died after their required beginning date, which means their 60-year-old daughter would have 10 years to distribute the account and take it over their life expectancy as well. So the account has to be emptied by the end of the 10-year period. Now, when that 60-year-old person dies, the person who inherited it from them must continue whatever schedule they were on. They don't get any extended period. Now, here's a different scenario where the 80-year-old person dies, leaves it to someone who is an eligible designated beneficiary, taking distributions over their life expectancy. Let's assume that the life expectancy is 40 years. If they die 10 years later, then the successor beneficiary who inherited from them have 10 years over which to distribute the account or the remaining life expectancy. So the 21-year-old child that you mentioned only plays a part into that factor if they inherited it from their real parents. Yeah.
So many traps along the way, Denise. It's a wonder anyone owns an IRA.
Yeah, but it's tax deferred, it compounds.
Right. So anything that we haven't covered or anything just bears reemphasizing before we
Yeah,
wrap
I
up?
think a lot of people are asking, well, do I have to play catch up come 2023? No, you don't have to. Take it if you want to, take it if you don't want to. There's no penalty. But definitely have a conversation with your tax advisor because now you're talking about a maximum period of 10 years. If you inherited $5 million, do you want to bunch it up in 1 year to take it or at the end of the year? Maybe your tax advisor will say, looking at your tax profile, it really makes sense to spread this out over 10 years at, take the RMD, the minimum amount, yes, but sometimes might make sense to take more. Right.
Well, Denise, it's always a pleasure chatting, having you share your knowledge and wisdom with us. I can't thank you enough. It's
Always
appreciated.
a pleasure to be here. Thanks for having me.